Being a financial data analyst and because of the huge demand from you guys, I have finally created this video. I know so many of you have messaged me saying, I can't understand what these funds are, or I'm confused between index funds, mutual funds, and ETFs. Which one is good for me in 2025? And I get it, this topic sounds complicated, but honestly, it's way simpler than you think. So in this video, I'm going to break it all down like we're having a casual conversation. We'll go step by step with real-life examples, recent numbers, and super easy explanations. And at the end of each section, I'll ask you a quick question, because I want you to actually think about which one is right for you, not just listen passively. Ready? Let's dive in. Section 1. Why this topic matters more in 2025. Before we even talk about what these funds are, let's zoom out and see why this conversation matters right now in 2025. Here's the reality. If your money is just sitting in a regular savings account, you are losing money in terms of purchasing power. As of early 2025, average savings account interest rate in the US, 0.45%. High yield savings account, 4 to 5%. Inflation, 3%, and can spike higher. So in a high-yield account, yes, you're barely keeping ahead of inflation, but you're not growing wealth. That's where investing comes in. And for most beginners, the three easiest ways to start are index funds, mutual funds, and ETFs. These give you a way to own a piece of hundreds of companies without having to pick them one by one. Question for you. Right now, is your money mostly sitting in savings, or are you already investing a portion of it? Drop your answer in the comments so I can see where most of you are starting from. Section 2. What is an index fund? Let's start with the simplest to understand. Index funds. An index fund is basically a big basket of investments that tries to copy the performance of a specific market index. Example of indexes. S&P 500 in the US contains 500 of the largest US companies. Nifty 50 in India contains 50 of the biggest Indian companies. FTSE 100 in the UK, top 100 companies listed on the London Stock Exchange. How it works? If you invest in an S&P 500 index fund, your money is automatically split across all 500 companies in the index. Apple, Microsoft, Amazon, Johnson & Johnson, Coca-Cola, and more. If one company does badly, you've still got 499 others working for you. Why beginners love index funds in 2025? 1. Low cost. Expense ratios can be as low as 0.03%. That's only $3 a year on $10,000. 2. Diversification. One investment gives you exposure to hundreds of companies. 3. Hands-off. No need to research or constantly monitor stocks. According to Morningstar, over the last 20 years, index funds have outperformed 80% of actively managed funds after fees. Examples. Let's say you invest $5,000 into an S&P 500 index fund today. If the market averages 8% annual growth over 20 years, you'd have around $23,304. And that's without adding a single extra dollar. If you also invest $200 every month, that could grow to over $148,000, thanks to compounding. Question for you. If you could invest in just one fund and forget about it for 20 years, would you? Or do you prefer to check your investments daily? Section 3. What is a mutual fund? Now, a mutual fund is also a basket of investments, but there's one big difference. Instead of simply following an index, a professional fund manager decides what to buy and sell. There are two main types. Actively managed, the manager tries to beat the market, or passively managed, behaves like an index fund, but in a mutual fund form. Why people choose mutual funds? 1. Professional expertise. You get a trained manager making investment decisions for you. 2. Diversification. Even with a small amount, your money is spread across different assets. 3. Automatic investment. You can set up a monthly SIP, systematic investment plan. The cost factor. Actively managed mutual funds have higher fees, typically 0.5 to 2% annually. Over decades, this can take a huge bite out of your returns. If you invest $10,000 for 30 years at an average return of 8%, paying 0.1% fees, approx $97,000 profit. Paying 1.5% fees, approx $76,000 profit. That's over $21,000 lost to fees. I once worked with a client who was invested in an actively managed mutual fund for 15 years. While the market averaged around 10% per year, their fund returned just 7% after fees, meaning they lost out on thousands of dollars they could have earned. Question for you. Would you be willing to pay higher fees if you believed a professional could beat the market for you? Section 4. What is an ETF? An ETF, exchange-traded fund, is similar to an index fund, but with one important difference. ETFs are traded on the stock exchange just like individual stocks. This means you can buy and sell ETFs anytime during market hours, prices change throughout the day, and you need a brokerage account to invest. Why ETFs are popular in 2025? 1. Low cost. Many ETFs have expense ratios as low as 0.03%. That's like an index fund right there. 2. Flexibility. You can trade them like stocks. 3. Tax efficiency. ETFs can be more tax-friendly than mutual funds. Example. Let's say you want to invest in the Vanguard S&P 500 ETF, ticker symbol VOO. If it's trading at $420 per share, you can buy exactly one share today and sell it tomorrow if you need the cash. Global growth stat. As of 2025, ETFs worldwide hold over $12 trillion in assets, compared just to $8 trillion 3 years ago. That's massive growth. Question for you. Do you like the idea of buying and selling anytime during the day? Or would you prefer to invest and just leave it alone? Section 5. After learning a bit these funds, now we do the quick comparison of these funds. 1. Management style. Index fund. Think of it like a self-driving car. You set your destination, for example, the S&P 500, and the fund just follows that route automatically. No one is taking detours or trying shortcuts. Mutual fund. This is like having a human driver. Sometimes that's great because they can react to traffic and try to find a faster route, but sometimes they get stuck in traffic or make wrong turns, and you pay them for the ride whether it's fast or slow. ETF. Most ETFs are like index funds. They follow a set route. The only difference is you can hop on and hop off anytime during the day. So if you want that instant action, ETFs are your friend. 2. How they're traded. Index fund and mutual fund both are priced once a day after the market closes. It's like going to a store that only updates prices at the end of the day, no matter what happened during trading hours. ETF, here's the big difference. ETFs trade like regular stocks. You can buy or sell them anytime the stock market is open, and the price changes throughout the day. So if you want that instant action, ETFs are your friend. 3. Minimum investment. Index fund and mutual fund, many require a minimum investment, maybe $500 or $1,000 to start. But once you're in, you can invest smaller amounts regularly. ETF, no big minimum. You just need enough to buy one share. And now, with many brokers offering fractional shares, you could start with as little as $10. 4. Expense ratio, cost. Index fund, usually the cheapest, sometimes as low as 0.03%. That's only $3 a year on $10,000. Mutual fund can be much higher, often 0.5 to 2%, especially for actively managed ones. ETF, very similar to index funds in cost, super low for most popular ones.
Index fund. Perfect for hands-off, long-term investors who just want to set it and forget it. Mutual fund. Good for beginners who want professional guidance, especially if you're investing through a retirement account or want automatic monthly contributions. ETF. Best for people who want flexibility, the ability to trade during the day, and potentially even lower costs. 6. Tax efficiency. Index fund is pretty good tax efficiency because there's not much buying and selling inside the fund. Mutual fund is usually the least tax efficient. If the manager sells investments, you might owe capital gains tax even if you didn't sell anything yourself. ETF, often the most tax efficient, thanks to their special in-kind exchange process that reduces taxable events.
Example to make it stick. Imagine you and 2 friends each want to invest $1,000. Friend 1 chooses an index fund. They don't touch it for years, paying very low fees. Friend 2 picks an actively managed mutual fund. A manager makes changes every month, hoping to beat the market, but they pay higher fees. Friend 3 buys an ETF. They like being able to sell quickly if needed, and they also pay very low fees. After 10 years, if the market performed the same for all 3, the index fund and ETF friends would likely have more money than the mutual fund friend, simply because of lower costs and fewer taxes. Question for you. If you had to pick today, which style sounds more like you? The self-driving car, index fund, the human driver, mutual fund, or the hop-on, hop-off bus, ETF? Which should you choose?
Index funds are great if you want a simple, low-cost, long-term investment and don't want to actively manage your portfolio. Mutual funds are best for those who want professional management and easy access, especially for regular, automated contributions.
ETFs are ideal if you want flexibility to trade throughout the day, possibly lower costs, and already have a brokerage account. So what is the bottom line? Well, all three options are suitable for beginners in 2025, offering diversification and access to markets. Your best choice depends on your need for flexibility, management style, and cost. Index funds and mutual funds are often best for new investors, while ETFs suit those looking for greater control over trading. Let me explain you with a simple example of Sarah, 28, works full-time and doesn't want to check the market daily. She invests $500 per month in an S&P 500 index fund and has seen her portfolio grow 14% in the past year. Her friend Mike loves market action. He trades ETFs weekly, sometimes making quick gains, but also taking quick losses. Question for you. If you had $1,000 to invest today, which one would you pick? Index fund, mutual fund, or ETF? So, what are the beginner tips for 2025? Number 1, start with low-cost, diversified funds. Number 2, use dollar-cost averaging, invest the same amount regularly. Number 3, have a long-term plan, at least 5 to 10 years. Number 4, don't wait for the perfect time. The best time to start is now. And number 5, reinvest your dividends to grow faster. All right, now you know exactly what index funds, mutual funds, and ETFs are, how they work, and which one might be best for you in 2025. I've given you the facts, the pros and cons, and some real-life stories. Now it's your turn. Drop a comment below telling me which one you'd choose and why. I read every single one. And if you found this helpful, make sure to hit the like button so more beginners can learn how to invest the smart way.